So we have with us Vibha Padalkar, the MD and CEO of HDFC Life. Vibha, thank you for coming to Moneycontrol. Vibha, if I can start off with a big picture question, if I may. The life insurance industry and the insurance industry was opened up 25 years ago to the private sector. It's gone through a long and complicated evolutionary period. There was a lot of allegations of mis-selling in ULIPs. 25 years later, how do you see the shape of the life insurance industry?
So thank you for inviting me to Moneycontrol. I am a huge optimist as far as the opportunity of insurance in India, the relevance of life insurance and pension in India. Now, you've mentioned the last 25 years, and I've been personally associated with this sector for about 15, 16 years. And while there's a lot of negative news flow here and there, you mentioned mis-selling, but let's look at the bigger picture. When we look at overall insurance penetration, it is higher than what it is among some of the large insurance markets in the region. Second is, if I were to deconstruct it, the number of relevant products that we have seen, for example, moving away from the plain vanilla traditional products, money back and so on, you have many others, the birth of unit-linked products, birth of interest rate guaranteed products with a life cover, birth of many variants of annuity products, term products, health with term, fixed benefit like cancer, cardiac and so on. So many such things. Also in terms of distribution touch points, from just having tied agents to bank assurance to direct to online and many other avatars of that. So that's another massive progression. Let's look at regulations. India is one of the most customer centric markets. If I were to look at unit linked in terms of charge structure and transparency, the charges are about 1/4 versus some of the large other markets in our region. If I were to look at term pricing for say 1 crore of cover for a 30-year-old is cheaper than even some of the Western markets. Definitely cheaper than the likes of Hong Kong, Singapore and so on. So every which way that I deconstruct, I think we are on the right path. I think the foundation and building blocks are in the right place. Let's not try to start jumping and sprinting before we can start walking. But I think we are on the right path in every which way to cover an average Indian citizen.
Would you say that insurance is an overregulated industry?
I want to be pragmatic on that, that right at the start, if the foundation is correct, thereafter some relaxation. For example, moving to risk-based solvency, wherein you're giving a lot more autonomy of how you're managing your capital requirements in the hands of the insurer and so on. So relaxing things after you have really set a good foundation, I think is the right way to go. Yes, some of the things that we have seen of recent times, for example, relaxation in terms of solvency norms, relaxations on some of the investment norms, or relaxation in terms of expense of management, all of that has started happening over the last 3 to 4 years. So it's always easier to accept it at the start, to say these are the rules of the game, let's do this properly, let's build in a lot more transparency, and thereafter start relaxing as some level of maturity starts percolating, not very dissimilar to banks.
So before I throw it open to Hansini for some more harder and more technical questions, let me ask you, there's also a proposed legislative change on basically life insurers getting into health insurance, general insurance and vice versa. How do you see that playing out?
So the insurance amendment bill is welcome, because what we really need is more distribution touch points and product innovation. Life insurers have something to offer in terms of distribution touch points. I see that in terms of those life insurers that want to get into health may do so. Where does HDFC Life stand? We are interested in expanding the pie and not just redistributing the pie. For example, today in my otherwise comprehensive life offering, wherein I cover life, I cover cancer, cardiac, I might even cover pension. One missing part is fixed indemnity piece. So I can offer that, but that doesn't mean that I am wading into their territory. It just means that I'm expanding the pie. So I think as long as we focus on how do we expand the pie, I think that's the right way, that's the right approach to go down the path.
I will go back to the earlier point made in terms of regulatory changes, etc. Just at the time when the industry was sort of stabilizing on regulations, and most of the large companies, including you, had a very clear runway on how things are going to look like. From 2020, we started seeing amendments after amendments on taxation. The belief largely is that insurance, like most of the financial products, tends to be dependent heavily on the Jan, Feb, March quarter. That was getting challenged also in some of the amendments that have come through. Today, would you call insurance a lot more, life insurance especially, a lot more stable after whatever has come through in the last 4 years? Or do you see these disturbances, sort of taking a little more time to cool down and for business to get back to what it was normally?
I would like to again look at that we are a fairly young sector and things are evolving. India is also evolving. So there are many moving parts and hence the regulations. For example, few years ago you did not really have interest rate guaranteed products and so on. Given that HDFC Life has been at the forefront of some of these products and then the industry has followed, meant that there could be some regulations that have to define how we move forward on some of these products. So this will be an evolving situation, and again not just in insurance but in any financial services sector, because ultimately all of us are acting in fiduciary capacity wherein we are holding funds of the common policy holder. Or the banks or the mutual funds, and that's why. So again, I'm fairly pragmatic about the why of it. Second part is an interesting one, wherein when I look back on, say, HDFC Life, after every significant disruption, we have actually come out stronger. We've also felt pain. We've felt pain after the very significant unit-linked regulations in 2010 and so on, and thereafter you mentioned tax, surrender charges. But we will grow stronger as a sector and while there's disruption. My only ask is that some of these could be with a roadmap, that it's not, that enough time is given for the sector to evolve, to bring out alternative business models so that disruption is not as severe. So the velocity of change is something I might have a different viewpoint, as against is the change itself required or not. Yes, I might have a different point of view on the tax changes, and I do believe that 5 lakhs premium per year, which is tax free, 5 lakhs is perhaps not an HNI the way it might be construed as in today's situation. So I might have a difference on that, but maybe a 50 lakh premium is an HNI or some such number. But what I'm proud of is that as a sector this year, if you were to look at FY25, we have started growing well as a sector. HDFC Life itself, despite this tectonic disruption, has grown by 31% in the first half of the year and so on. And why is that the case? Because the fundamentals of need for insurance, that hasn't changed. So my only appeal will be that the velocity of change can reduce. It will be nirvana if we could have at the start of the year whatever changes that need to happen, that they happen, and then we are left to conduct our business.
Would you agree with me then that the life insurance space in particular is going through a reasonable sea of changes? Because right from the way products are being thought through to the way how you deliver the product to the customer, it's not what it was even 5 years ago.
Yes, but again, just balancing things out, there are also many positive changes.
Sure.
Like I mentioned, expense of management and solvency, and so many positive changes. And then yes, there have been disruptions as well. And that's where I think disruptions are par for course on, how do you tide through those disruptions? How do you anticipate some of these disruptions? And our core philosophy, our core strategy is to have balance in what we do. We have a balanced product mix, we have a balanced distribution mix, so that all our eggs are not in one basket.
I'll now come to a slightly larger question, industry question. One of the reasons, especially for the listed players, to be considered as a favorable pocket within the financial services space is that life insurance is not as deeply penetrated yet like another product would be, let's say lending. But it's continued to remain at a sub 10% in terms of penetration. What's your take on this, and how do you see it maybe 5 years or 10 years from now?
I feel, I look at the glass half full and let me deconstruct. When I joined the sector 15 years ago, people used to say, why do I need term insurance? I have my, I've educated my kids, I've got my house, and I don't need anything else. Today, maybe also thanks to COVID, nobody's asking, why do I need term insurance? And that is a tectonic shift. Term insurance used to be 0.8% when I joined. This was in 2008. Today, it's almost touching 10% in certain months. This I'm talking about retail term. And I have to sell maybe 2.5 policies to sell one savings, and yet it is close to 10%, in between 8 to 10% for several companies. So that itself is a big shift. Pension is another. People used to say, again, I've educated my kids, my sons will look after me, I live in a joint family, whatever. Today, the Sar Utha Ke Jio tagline, people understand it. People did not understand why were we saying Sar Utha Ke Jio at that point in time. So that again is a tectonic shift of people saying, yes, I don't want to embrace sannyas after at 60. I want to do many things. In fact, this is between 60 to 70 is my time of me time, right? So, and all of that costs money, and what do I have to invest? They might not be savvy enough, and that's our job to educate as to how much will I need for this lifestyle between 60 to 70 and so on. But they're really no longer asking, why do I need to save for myself? These are very significant cultural changes, socio-economic changes that we are going through. So I think we are again on the right track. Medical insurance is another. Post-COVID, people today are, people are traveling a lot more. Travel insurance, you're moving away from just a family floater or from just employer-led medical insurance to having your own. So all of those things are moving in absolutely the right direction.
What about the factor on micro insurance? Because that's something which continues to remain a state penetrated product. It is a push from the state which is nudging even the private sector and maybe even the largest public sector enterprise also. How do you view it?
The way I view micro insurance is that it's not that we're not doing anything. Let's start off with Credit Life. Credit Life, 1/3 of our business. Credit Life is when MFIs give loans and we cover those loans. So unfortunately, if a buyer were to pass away, then if a borrower were to pass away, then his loan is covered and we pay whatever is due to the lender. Now that is 1/3 of our business, which is large. So at least people are not being saddled, or the families of the deceased borrower is not being saddled when their home is under threat. And given that 1/3, which is a very meaningful part of our business, is now under Credit Life MFI, that's a big shift. So that also is insurance. Second part is PMJJBY. Again, that is a meaningful part because on death you get a fairly reasonable amount, your 2 lakh of rupees and so on. Thereafter, the regulator is just in the process of rolling out through Bima Vahaks, which are state level entrepreneurs, largely ladies, to sell Bima Vistar, which is a combi product wherein you'll have little bit of life, little bit of health and so on, as a combination product, simple over the counter product on a platform which will be through Bima Sugam, which has just been launched again. And that the risk that is going to be borne will be pooled risk. And that again is sensible because none of us have enough data, because what was really holding us back were two things. One is inadequate data. So I need to have underwriting to be able to give larger amounts of cover, whether it's life or health, which was largely absent. And second is, how do I get to them? So that the regulator through this, in a cooperative way, wherein all of us, every insurer, whether it's life, health, general insurer, all of us are in it together. There will be pooled risk, and hopefully this will start penetrating because it's a simple over-the-counter product with, to some extent, assurance from the regulator that these products are right for you, and there will be, they will have oversight of claims and so on. Once people down the line start experiencing money when a tragedy happens, that's when percolation will happen.
You're making a hard point there.
So just to come back on one issue which you raised, obviously I am completely, that there is a growing acceptance that health insurance is essential. But when it comes to life insurance, have you been able to break through, or the traditional Indian mentality that insurance is primarily an investment product? Is that, or is that still work in progress?
It's still work in progress, but we are making progress. I think that is that is very, very heartening. And again, let me deconstruct this evolution, because the expectation is often to go from 0 to 100. This revelation to come that I need it and I want it. That it doesn't work like this. And let's take term insurance. That's the purest form of life insurance, which is not savings-led insurance. It will start off with saying that, like credit life, that I don't want to leave my loan to my loved ones, especially if they're not income generating, or I don't want that loan, my house to be seized to pay off the loan. So let me cover. As long as the loan is there, let me cover. We are at that stage now for many people, which is good. Second is to say, okay, I have my employer has some cover, but the employer is giving me an opportunity to say, you can cover your in-laws, you can cover XYZ. If you have 3 kids, you can still cover 3 kids, but you pay more. So it's a co-pay, some basic level, employee plus 3 dependents, but more you can pay. So at least everyone in the family is covered. So that's second part. Third part is to say, many people would say that, nothing's going to happen to me, I'm going to pay all this premium, and then company is going to make a lot of money, and it's an expense. So we would tell them, okay, fine, nothing's going to happen to you, but if something happens, then let's give you a cover. But if you survive 10 years or 15 years, I'll give your premiums back. We are there for many customers at that stage now. Of course, the premiums are going to be more expensive, but at least because of that, they're going to buy some level of cover, which is more than 10 times cover, which is what typically you will get in a savings product. Another avatar is in unit linked itself. If markets are roaring and unit linked is the flavor of the season, then we are saying instead of 10x cover, why don't you take higher levels of cover, 50, 60x, 70x cover. So we are there also today. Many customers like the chassis being of a unit link, but some of these nuances coming through with higher levels of term. So there's a lot of furious paddling happening beneath of increasing, and that is evident if you look at our sum assured. You will see that our sum assured growth is about 50% kind of a growth, while you will see that the overall premium growth is about 28 to 30%. So more and more cover is being given. We are relatively agnostic of which way an average Indian gets more cover. Yes, ideally it should be pure term, but there is a process to getting there. There is, there is a maturity in the market to get there. Younger people will get there faster. Older people, because they've been used to savings, and again, savings-led insurance is not a bad thing, because at that time that was the right thing. Now people are increasingly open to thinking about more and more cover, and I am very sure that as per capita GDP of India continues to inch up, it will no longer be really hand to mouth that can I afford to pay and so on. And this product innovation is certainly helping. Today about 1/3 of our term is coming through some of these other solutions, such as I'll give your money back, nothing is going to happen to you, assurance, so that you're not only talking about death and disability. A lot of it is also socio, cultural ways of thinking. So we have to be respectful of that.
How have ULIPs been doing in the last year or so during the stock market boom? Because you have to compete with mutual funds, right?
Yes. Yeah, so ULIPs are doing very well, as would be expected. This is not the first time, this will not be the last time. As there is a close correlation to markets, and people also like the simplicity of unit links, and it is a simple, transparent product. So nothing per se wrong with unit link. And I want to take a moment, while that was not your question, we are often compared with unit link. But if you were to look at the horizon, after the 5th or 6th year, unit links start becoming even more compelling, because your charges even out. It's not based on as a percentage of your fund value. So unit links are doing well. For us, it is about 36 odd % of our business, slightly higher than where we normally peg unit link to, but it is it's the pull of the market.
And how has that number been as percentage of your business? It's now 36, but historically 36. Over the last few years, how has it been?
So it used to be around 1/4 of our business, and that's gone up, but Q2 was lesser than Q1. Q2 has come down to about 35% of our business, as against about 38% of our business. So trending, but it will continue to remain elevated as long as markets do well, and that's okay.
Anyone who bought a unit linked policy many years back, it has made huge amounts of money.
Yes, and exactly your point that a few years ago, it will make money if one is patient.
Yeah.
As again seeing this as a 5-pay product, this is a long-term insurance savings product,
Right.
and not a quick to flip kind of a product.
Right.
But as an entity where you tend to be a little more conservative versus market, does the 35% plus share of ULIP somewhere trouble you? Because this can be a volatile product. It's often pegged to the market. Markets are doing well, therefore this product is also seeing a lot of demand.
I am not sure we would call ourselves conservative as far as products are concerned, because we are known as a product factory.
Sure.
Right, so we are the ones that keep coming up with, you name it, and every new breakthrough product has come from HDFC Life, and so we'll continue to do that. Unit linked has a rightful place. We like the product, and it's like I said, easy to understand, transparent product. But the economics again are not as compelling, and second, more importantly, is that this 5-pay, wherein people exiting, so persistency tends to be somewhat lower than our overall persistency. If it is a 7-8 people stay vested in the policy, then we have no qualms whatsoever about selling more unit linked product. Also, it needs to be the right product for the right customer, so that if people make the wrong choices of going with the markets, people who don't understand enough might get burnt. Markets do go up and down, and so these are some of the things of the market. The product needs to be the right product fit also. All our products, and while people talk about unit linked being range bound, but even our non-par products are range bound for us. So when we launched Sanchay Plus, just when I took over as the CEO,
one of your flagship products.
One of our flagship, I launched it just about 6 years ago.
Yeah.
We could have easily sold about 60 to 70% of our business, because there was no other competing product like that. Right? But even then we said, no, we will not sell more than about 40 to 45% of our overall. Even there we wanted to put the brakes. So it's more about having a balanced product mix than saying no to a particular kind of product.
There are two reasons why I asked this question at this juncture. I'll go with the first one. Persistencies for you, whether I look at a 13-month or 67th, has shot up quite significantly, which somewhere also demonstrates the kind of efforts that as a company you've put to educate your customers to stay put with the product. Unit link, as you mentioned, can disrupt that. So where do you see persistencies, given how ULIPs have sort of taken a share of your pie, stay in the next 3 years?
I think we are, as a sector, doing fairly well and quite responsible behavior as far as persistency. This I'm looking back, hindsighting last decade, and we have meaningfully moved the needle. Like you said, we are very happy that our 13-month persistency has increased by about 200 basis points, and 61st about more than 700 basis points, and we'll continue to inch upward. I think we are at a decent place. Unit link can easily go up further if, for example, some of the current features are no longer there. For example, on discontinuation, supposing you start paying, stop paying after the first or second year, you don't lose out very much. You do get a guaranteed sum. Now, why would we want to give someone who is in a way errant a guaranteed return? Right? Some of those tweaks can help take up unit link persistency a lot higher. But we are now in the mid 80s and as a sector, and we'll continue to inch. So overall 13-month persistency will continue to move up. As far as HDFC Life is concerned, we are fairly focused that when we sell a policy, we do engage with customers and coax them to sign up for a standing instruction, so that they don't forget. So you're not forcing them to think every time, because when you think, then you say, okay, I want to go on a holiday, let me not pay my premium or something like that. So that it just goes as an auto, unless you specifically stop it. So it's kind of a reverse decision that you have to make. That has helped a lot. I want to give you another just a factoid, wherein when we acquired Exide Life, erstwhile Exide Life, since then the persistency, their persistency was in the mid 70s. That's gone up by about 400 to 500 basis points, just by some of these tweaks. Also engaging with the customer, we do have propensity models to say what is the propensity of this customer ceasing to pay their premiums, then we would rather not sell that policy to that customer. We'd engage with that customer to say, is this really what you want? Is this type of policy that you want, or you want some other solution? You know, and so on. More transparency upfront than saying, I didn't know these were the charges, I didn't know these were the terms, and so on. So many such big and small things has helped us stay right ahead of the pack on persistency.
You made an interesting point on Excite, but I'll come to that later. One of the reasons why HDFC Life commanded the premium that it did during your IPO and much after that against the other players is that your margins were the industry best. Today there is there's a thread of a difference between each of you in terms of margins, and you frequently come out with commentaries that such high margins may not be sustainable in the long run. What's your take on that right now?
So few things. I think it's more than a thread. It's almost 200 basis points more than that, which is quite meaningful at our scale. Another point is we have consistently maintained the margins. As against a lot of yo-yoing, you'll see anything between 300 to 700 basis points drop in margins, you know, and so on. So there's been a consistency that HDFC is known for. Third point is that we have doubled our VNB in cohorts of 4 years. So that track record has also been there in terms of the same consistency that I'm talking about. And it's not just one cohort, but several cohorts of 4 years, again, which I think not many peers will be able to say that. Now, we also talked about all the regulatory disruptions. It's largely to do with some of those disruptions that as our business model changes. For example, last year, as a sector, we were recovering from a very tectonic change due to tax related changes. And so you will find some pressure on margins because of this. Unit linked is another reason that we just talked about. So in terms of order of priority, number one priority is that we have to grow. We have to grow well in terms of new business, and we have been growing slightly ahead of the private sector growth and comfortably ahead of overall sector growth. Second is value of new business growth, which will be in the 15% plus range of growth, 15 to 17%. So that again is, so that's akin to profits PAT of a bank, for example, that has to grow well. And then margins are an outcome of what that outcome is, because if you have a particular period where a unit linked is doing well, there might be some pressure on margin, or you're investing in certain technology like we're doing right now. We are going through a tech transformation, which is close to about 400 to 500 crore investment. Then there could be something that is just specific to a particular situation. But your value of new business will grow. Some of the margin drivers, one is term. As we continue to write more and more term business, that should see an upward bias. Second is some level of stability in regulations. Reason I'm a little bit cautious is you really don't know what level of stability, but some level of stability, I'm reasonably hopeful that in the medium term, margin should continue on the upward trajectory. So I'm not too worried about per se the margins. If you were to look at just the scorecard on, if you were to look at the last 5 year CAGR, 3 year CAGR, we have grown faster, comfortably faster than the market, both in top line and value of new business growth.
Fair enough. I'm going to draw a little bit of comparison between you and your immediate competitor, another bank-led insurance company. HDFC Bank is a lot more supportive on your banca business now, or rather you're doing much more banca now with HDFC Bank and other banks versus your immediate competitor where the parent bank is slightly withdrawing. What's working between you and HDFC Bank much better versus your competitor at the juncture?
I think the clarity of purpose, that banks have these touch points, they have the customers, and if HDFC Bank or any of our partners don't sell life insurance to those customers are going to go and buy somewhere else. So you would rather ring fence to say, why do you want to go anywhere else? I know you well, I know what works for you, and I will give you the right product. So the trust is there, the long term connect is there with the customer. So I'm absolutely in the camp to say that I'm able to give you all these solutions, every financial solution I'm able to give it to you. HDFC Bank has embraced open architecture, so they are not forcing it on the customer. They're saying, these are insurance solutions. If you want any of these insurance solutions, you can choose any of these partners, than the life insurance partners. I think that's the right approach. And like I said, the customer is not going to wait that if my bank doesn't sell it to me, then I'm going to go elsewhere. The customer, so why are you, inconveniencing your customers to go somewhere else and look? You can give the same experience over here and slightly better, because who knows the customer better than your own bank? If the customer is ready, yes, they can. I can issue a policy virtually the same day, but I would rather that the customer looks at it that it's a 10-year, 15-pay product. I'm covering the lives of my loved ones, and let me take an hour on a Saturday afternoon and think about it, which is the right variant for me. Let me engage, let me do my own research, let me talk to people that I trust, and then make a decision. And so these are very different products that are not comparable. So short answer is no, I don't believe that in life insurance there is going to be holistic disruption.
But where do you see yourself in the whole phygital curve, and how much do you believe that maybe over the next 5 years you would still be a human interface business? Because
even today,
somewhere in the West they are moving away from it.
Absolutely. Even today, I'm not. If the customer is okay with no human interface, I can do from solicitation to policy issuance and servicing with zero human. I have the tools today. And not just that, not just from the customer, wherein they can come online or through an app, put in a few vital unique identification, and I can pretty much get most of the data, especially for a younger life, especially for a life that's less than 45 years of age, with next to no friction, next to no in-person. A lot of medicals can be done without in-person medicals, and so on, policy issuance, servicing thereafter. Even you don't need to walk into my branch, I have virtual avatars. You can just click on the link and have a virtual avatar, and even either a in-person operations person like me you can hook up, or even an avatar, that avatar of me that you can hook up and talk to. It's so claims, for a very important aspect, no need, zero touch claims processes. So we have all of those tools, and post our transformation, and as we roll out, the first rollout of the phases happening in December, and then thereafter every quarter we will have different phases rolled out, even more so, for example, in credit life, for us to again zero touch processes. So today the customer still wants that hand holding, and we are respectful of that. Why we will nudge to say, hey, you can do a lot of these things in your own time on a Saturday night or whatever that, so it might be easier for you, but it will take time that younger people will move towards that of self-serve. We are there if customer wants that hand holding or that assurance that, because these amounts are not trivial.
Sure.
And so we are disrupting ourselves before there's a tech disruptor, and increasingly we will become a insure tech company that also manufactures insurance products.
Nice.
That's how we see ourselves. And last point I want to make is not just in terms of how we sell, but also the entire back end process, even training. For example, today we have 36,000 employees, and imagine with training on all the new products that come up, physical trainers can only do that much. Today, through AI ML, the young rookie person who's joined our company can undergo a product training, can then play out a mock, and wherein the tool is looking at it, that individual, and gives feedback on things like accuracy of product understanding, accuracy of your voice intonation, confidence levels, convincibility from the customer's point of view, and give that feedback instantaneously, and also through local languages.
Oh, nice.
Right. So it's every aspect of our organization is touched by this. Even for example, on our call centers, through voice modulation, an irate customer does not have to say, all of us say, no, I want to talk to your supervisor when you're really angry, right? You don't have to say that. The call barging will happen when certain, decibel levels go up or certain words are used. Same thing when people write in. It is no longer first in, first out. When you write certain words in an email to say, I'm very angry, I'm very upset, there will be a separate way of dealing with those.
How would it help you save cost, let's say by FY28, as you increase automation?
See, I don't want to drive this as a cost center. I want to drive this as a productivity increase. Costs will happen because it's very easy to say, you know, I want to be cost focused and get really close to the bone. I don't want to do that. But yes, we do have internal targets of what does it cost. I don't want to share too much, but what does it cost today per policy to service a policy, and I want a saving on that, fully bundled, right from what does it take to collect a premium, what does it take, what are your credit card charges, every kind of cost, I want to reduce that. That will happen, but I'm not driving it as a cost reduction. It's a productivity measure, that how much more can I get to do by paying the customer lesser. That's how we are approaching technology solutions.
Are Indian customers now accustomed to buying insurance products digitally, life insurance products? What is the percentage like?
Yeah, so today between our entirely online channel and some of the digital channels, it would be close to about between 10 to 12%. So increasing day by day, and younger customers will move towards that.
Would you look at acquisitions?
Yes.
So we've been the first life insurer, as you know, in this space, and this culminated. But in the past, we've looked at about 4-5 other targets. So if there is a good opportunity, we are always willing to consider it. But we are growing well organically as well. So it has to make sense. It has to be accretive. Exide Life was a great buy and added to our agency proposition very well. And not just that. So it added about 33% to our then existing agency channel, but now is growing even faster than our erstwhile agency channel. So it's in a good place. It's also selling a lot more term than at a company level. At a company level, we are about 6% term, while they are about 2x that, at about 12-13% term. So you can imagine the profitability of that channel. And third is, where are they present? So they're present largely in tier 2 and 3, and which was not our core strength. So that also they're doing well. I also mentioned earlier about their persistency is also moved up quite meaningfully. So quality of business is also growing. And they've replicated their stronghold model in the south to largely the branches that have been opened this year and planned for the rest of the year is in center, like an MP, in the north, in the east, and so on. So replicating that model. So we're very happy with that acquisition, but it was a well thought through acquisition. If something similar comes wherein it can be accretive to us, then we'll certainly look at it. But as of now, I think we're focused on organic growth.
And you've always also been one of the advocates that Indian companies like yourself, you don't need to bank on a foreign promoter any longer. They don't bring an alpha into the business. Do you still stand by that view, given that one of the other life insurance companies, there is a possible disruption between the domestic promoter and the foreign alliance? Do you see that? I mean, this is a view you had 5 years ago. You still hold on to it?
Absolutely. And the reason I'm smiling is I used to work for an FMCG company, and a lot of the advertisements used to go to their region and to get approved. And even at that time, as a rookie, I used to think that the Indian ethos is not fully understood by another country, and and so on. And that's the same like we just talked about today, that there are socio-economic nuances. There are reasons why people do what they do and think the way they think. There are reasons why millennials in India thinks differently to their parents and their grandparents to whom I'm trying to ask them to buy pension, and parents for their savings and so on. So those nuances are lost. We have to have bespoke products, and reason HDFC Life has been a product factory is that we talk to our customers, and those even more importantly who are not our customers, as to why didn't you buy, and they would say, I'm trying to solve for this, I'm trying to solve for that, my kid has gone abroad and I'm here, but I have my parents here, so how do I solve for this? So it's things, the ideation stems from that, and not a single product is because it has worked in another BRICS nation or something like that it will work in India. Not a single product, at least in HDFC Life. And these have been blockbuster products. So I think that ship has sailed. We need any intellectual horsepower from somewhere else.
Great. But there's also a lobby, if I'm right using that word, that FDI in insurance should be taken to 100%. It should, we should have a lot more participation from foreign investors there. How do you see that from a domestic standpoint? What is the alpha that they can bring to the market?
See, I'm for the more relaxation, the better. So, fine, if someone wants FDI to go up, fine. But realistically, if I were to look at numbers, not that much capital has come in after taking it up to 74%, let's be honest with it, for whatever reason. Why is that the case? Reason is they have to make money in India. And it goes back to any kind of disruption in terms of regulations, that if there's a roadmap to saying we'll stop now unless it's very important from a systemic level, and even that it's not done by 1,000 cuts, it's combined as a roadmap, then there will be some business models that will work for the foreign investor to say, it makes sense in India. They're unlikely to come to India only because there are so many people and so many people per capita is going to, I don't think so. Again, it has to be hard economics to say what can I expect, which economy should I invest in, that I compete today not only versus my peers but largely versus where can the $100 be invested, which other economy, can it be in X, Y, in the region. If a Vietnam is giving a better return, money will flow there. If a Philippines is giving a better return, it will go there. So I'm actually competing with what is the lay of the land there in terms of stability of business outcomes. I think that's really what we need to solve for, and money will follow. Yeah.
One last question from my end, and it's a slightly market question. The time when Max was already listed, you came out public, SBI came out public, and ICICI was there. There was a lot of market interest in life insurance stock. It continued till the COVID. Somewhere the narrative seems to have, changed a little. Most of the life insurance stocks are now categorized in the underperformance space. What do you think led to this sudden change? Because at one point life insurance stocks were being sold, or rather being preferred more versus banks. That narrative is flipping. What do you see it as the reason for that, and how do you think this is going to play out in the next 3 years?
They're no longer seen as growth stocks, to put it different, which ideally, given what we've discussed, low penetration of insurance, should be the case.
Yeah. So few things at play here. Worldwide, banks and insurers work in tandem, conversely. So when banking stocks do well, you will see time and again insurance stocks down, and vice versa. Insurance is seen as a long-term defensive play, while tactical advantages based on where interest rates are, like our banking system was in a sweet spot not long ago, when most of the bad news on doubtful loans were adequately provided for, and there was a benign interest rate environment. And that's when they would. So nothing to do with insurance per se, but there is this cyclical nature, and these work in tandem in opposite directions. Second is that the regulatory disruptions that we saw, COVID also happened, not just regulatory, but COVID happened. So there was one thing after the other, and markets were perhaps somewhat spooked that where is this leading to. I actually have a diametrically different take on this versus markets. Look at our return on embedded value. It's been in the range of about 16 to 18%, which is really, what does it mean? It means long-term value creation that is nicely flowing to cash at this kind of a rate. That is number one. Number two is that it's well known that life insurers have more solvency capital than is required, which means again no skeletons from the closet, as far as bad news on anything that's concerned, because we are adequately capitalized. This I'm talking about the top 3 or 4 companies. Third is, if you were to look at the margins, if margins like our margins for example are hovering around 25%, I think that's a pretty decent margin. To expect it to be around where our closest competitor in the region is, these are different regulatory environments. Like I said, on unit linked, their fee income over a long term period is almost 3x if not 4x of what you make in India. On par, they make 3x of what we make in India. We have 10/90 sharing versus 30/70 sharing, and so on. Many nuances which are favorable over there. Surrender charges are much higher over there. So it's not really realistic. However, if you look at the growth opportunity, a growth that I just talked about, even at an industry level in the 20s, compounded over the past several years, is again a very healthy growth. So I think there's a little bit of expectation mismatch coupled with skittishness to say I don't know what is around the corner. I think that's causing that. I think little bit of longer term view on just letting the sector be, I think will bring the confidence levels back.
Great. If I can push in one last question, I'll keep it really the last. Life insurance companies, especially given the kind of papers that you underwrite, long term, 30 years and so on, you've been partners in terms of infrastructure building. You've been one of the core reasons supporting banks in their capital raises in the past. You continue to do the latter part. How do you see yourself play in the infrastructure space? Would you continue to buy those kinds of long-term bonds? At HDFC Life, what is your investment philosophy on that aspect?
Absolutely, and this is not just in India but worldwide. Life insurance companies are the largest investors in long-term pools of capital, and it's a perfect match made in heaven, if you like, that we are looking and hungry for long-term capital because we do write long-term business and give longer-term guarantees for which we need surety against it of good paper. Of course, Government of India paper is the best, and also you have other such paper. So and that's why there's a natural affinity for this. So we do see ourselves seeking good quality long-term paper, and in fact as the bond markets deepen, when you're talking about 40-50 year paper issued by the Government of India, that's something that we will be naturally suited to absorb those issuances. So yes, I do see life insurers continuing to play a very meaningful role in participating in those issuances. And you mentioned infrastructure, housing, these kind of go hand in hand with our need for having such paper.
Thank you so much. Thank you.
Thank you.